Is the stock market cheap or expensive at the current price level? This is a fundamental question that investors are thinking about all the time. And there's different ways to gauge it, but today I want to point out one specific measure which indicates stocks may be on the rich side, which of course increases the risk of lower returns looking forward. Today we're talking about the equity risk premium, which sounds technical, but don't worry, I'm going to try to break it down in simple terms. Stick around. If I were to offer you two different investments, they both paid 4%. The only difference between the two is one entailed some level of investment risk, i.e., risk of loss, while the other was completely risk-free. Which would you choose? Well, obviously, in this scenario, you choose the risk-free investment because why would you take additional risk for no extra rate of return? In the financial world, we can take this simple concept, i.e., riskier investments should offer higher returns, to gauge whether or not specific asset classes like the stock market look cheap or expensive against some risk-free rate of return like government bonds. All right, I feel like I'm using too much investment jargon already, so let me give you a simple example to illustrate my point here. Imagine that you are offered an opportunity to buy a business, and this particular business earned $175,000 of net annual profits. But to get this business, you have to pay nearly $4.5 million. Well, we can do the quick math, net profits divided by purchase price, and figure out that year one, assuming profits are basically flat, we're going to earn 3.9% on our $4.46 million investment. Again, is this a good deal? Well, one of the ways to judge that is, again, comparing against something where we don't take any risk. And if we look to the Treasury market or the market for U.S. government bonds today, here it's mid-September 2023. We've had a huge run-up in interest rates over the last 18 months. You can buy a 10-year Treasury today and that pays you 4.32% with no risk of loss. So my point here is anyone looking at this situation, should I buy a diversified business, and let's further make the assumption there's not a lot of growth potential, that's going to pay me less than 4, or should I just park my money in U.S. Treasuries that's paying me over 4? I think it's pretty obvious. You'd probably, this doesn't look that attractive in comparison to government bonds. And we can do the same type of analysis for the broader stock market. Now, this chart provides that analysis. Specifically, in blue, what we're looking at is the earnings yield of the U.S. stock market, the S&P 500. We're graphing that against the 10-year U.S. government bond. So basically the same type of analysis we just looked at in that hypothetical example. And what I want to emphasize is over the last 20 years or so, the blue line, typically there's a significant gap above the tan line. And this is investors demanding a higher return from what's generally considered a riskier asset, i.e. stocks are generally riskier than bonds. But what's concerning today is we have bond yields which are now exceeding the earnings yield on stocks. So it's much the same if we go back to our previous example here. This is indicative of where the stock market is today. We have this diversified collection of businesses generating an earnings yield. I think, in fact, this is what the earnings yield is of the S&P 500. The chart's a little bit dated on the data. And that compares against what we can earn on a risk-free basis from U.S. government bonds. So the bottom line here is, in the most simplistic terms, stocks are looking less and less attractive relative to risk-free assets, in other words, government bonds or treasuries. And this ultimately means that there's increasing risk in the stock market. Because you think about it, if long-term interest rates continue to creep up, let's say they exceeded 5-6%, if stocks were still hovering in the same level where the earnings yield is around 4, that gets to be a pretty out of whack equation. Just think about it yourself. Would you want to own stocks which can go down 50%, in any given year, While the earnings yield is 4%, obviously you got the potential for upside growth, but there's a lot of risk associated with that. Or you could just hang out over here earning 6% on treasuries, hypothetically speaking. My point is the more out of balance that equation gets, the higher the risk of a significant rebalancing of capital, i.e. stock prices going down. So the last thing I just want to mention here is just because stocks look expensive on this relative measure, it doesn't mean the stock market's going down today or tomorrow. These things can go on far longer than anybody ever anticipates. There's just no question about it. But I point this out because it certainly suggests that risk is elevated today, which means, therefore, our expectations for future returns, at least in the short term, say 2 years out, should be lower than they would on average, generally speaking. If I was putting capital to work today, one of the approaches I would take is spreading those purchases out to avoid, buying all at a very inopportune price. So anyway, I felt like I rambled a little bit too long on this, but this one got a little technical as well. Nonetheless, it's an important data point given the market makeup today. We've had this major rebound in the marketplace to most people's surprise, but it looks like it's a little overdone. Look, as always, thanks for watching. I hope we'll see you in the next one.